Good afternoon and welcome. Thank you for joining us today for our 10th session for our first virtual Successful Aging Expo. My name is Lindsay Haynes, event manager with Prairie Mountain Media, and I will be your moderator for the webinar event today. Before we get started, I did want to go ahead and point out that we do have an active chat and Q&A portion of the webinar located at the bottom of your screen. So whether you're on a tablet or a computer, you'll go ahead and at any point during today's presentation, if you have something you wanted to mention or a question that you wanted to ask our presenter, you'll go ahead and enter it into that Q&A portion there. We'll have about 30 to 40 minutes of our presentation today. And then the last 20 minutes, right before 1 o'clock, we'll wrap it up with some Q&A. So I also wanted to remind everyone that this webinar is being recorded and you will have the opportunity to go back and watch it again, watch our other webinars that we've had throughout the last couple weeks, as well as check out our sponsors and our supporters on our website. So the URL for that is timescall.com/aging. So our presenter today will be discussing reverse mortgages. And as the president of Orion Mortgage, we have the honor to hear from Donald Opeka today. So Donald, I'll let you take it over.
Thank you, Lindsay. I'm Don Opeka with Orion Mortgage, as Lindsay said, and let me flip over to the share screen. What I'm trying to do today is talk about how people have used reverse mortgages to their benefit, and I'm more concerned with the stories behind the loans than I am getting into the weeds of the technical data, but I'm happy to talk about the technical data separately or later. If you have specific questions, I'm happy to talk about those things. Reverse mortgage is a loan for people over 62, generically, and it's a way to turn the equity in a home into cash so that you can spend the money either by reducing a mortgage payment, getting more monthly payments to you, or a lump sum can come out as part of the transaction. Don't forget about the senior tax exemption. If you've been in a home over 10 years and you're over 65, you want to take care of that. And then you're obligated with a reverse mortgage to pay taxes, insurance, and maintenance. We routinely get questions about where the name Orion Mortgage come from. It came from my time in the Navy whenever I was flying this airplane, that specific airplane, in fact. And as we were going through names for the company, I looked up at the bookshelf, saw the model I got when I became a plane commander, and asked Terry if Orion Mortgage was good. She said yes, and so we named the company Orion Mortgage, and it's been that way since 1996 when we started. We moved to our current location in 2001. 2006, we were among the first licensed in Colorado. We originated our first reverse mortgage in 2011. Amanda Varga, who works with us part-time, joined us in 2012. And in 2017, Terry and I got a reverse mortgage for ourselves. In 2017, I was also became a certified senior advisor. I joked to the people when they were trying to get me certified that I was already a certified senior. I'm 74 now, so I think I understand the issues of aging at least a little bit. There are also plenty of people who are older than I am, but I think I can empathize with the situation there. We go through several phases in life, and when we're working, money comes in from generally income from employment, and it goes out in giving, taxes, savings, debt reduction, and lifestyle. When a person quits working, things, the places for money to go don't change, but then the question is, where does the money come from to fund those things? It can come from Social Security, pensions, can keep working like I am, can come from liquidating savings, or it can come from turning real estate into cash, which is what a reverse mortgage ultimately is about. The basics on a reverse mortgage are that you have to be a minimum of 62. You can have a borrower over 62 and a younger spouse and get a reverse mortgage. And under those conditions, the younger spouse under today's rules would be able to stay in the house for the rest of her days as well. It needs to be a primary residence. You do qualify on income, assets, and credit. It can be a lump sum distribution. It can be a line of credit. It could be monthly payments to you, or it can be some combination of those. You're obligated to pay the taxes, insurance, maintenance, and live in the home as your primary residence to keep the loan in place. Otherwise, it comes due when you turn 150 years old. Closing costs are often a big deal for people when they look at a reverse mortgage, particularly against a home equity line of credit. The big one is the upfront mortgage insurance. FHA charges 2% of the property value up to a maximum lendable value of $765,600. That's the $2,000 limit. There can be an origination fee that can be from $0 to $6,000. That's limited by FHA. And then other finance closing costs, more or less $3,000 for appraisal, title work, and so forth. The only out-of-pocket item that we ask for is that the borrower pay for the appraisal, which is typically $500 to $800 paid for with a credit card. You can get the money back at closing. So it's not a big out-of-pocket expense, but as we're going through the loan process, there is no particular requirement that you close on the loan. So if we get to the end, we'd just rather not pay for an appraisal and have the borrower decide they don't want to close on the loan. There are also non-FHA products. With some of those, the minimum age is 60. They fit for non-FHA approved condos. They work for properties with a maximum value above $765,000. And some of those products have closing costs as low as $125. So when the objection is closing costs, that can be a solution. There's also no FHA mortgage insurance on those products, so that can be fine. On the fixed rate products, on the adjustable rate products, there are some issues, and we can talk about those separately. Let's get to the stories of how people have used these, and what I'm starting with is the oldest borrowers that we've dealt with, and then we'll work our way down to see how things change as younger borrowers get involved. These two, one was a man aged 99. He was over in Cedar Edge. He had a $110,000 home. This was about 5 years ago, and we got him a $79,000 line of credit. He paid for a new furnace, and it paid for private pay care so he can continue to stay in his home. The lady that was 104 was still in her first home, is in northwest Denver, $265,000 value today. It had been paid off for decades, but she had worn out her 80-year-old daughter taking care of her. So we talked about whether she wanted to stay in the home, whether that was a good idea or not. She wanted to stay there. We had a meeting with the family, and we got her a $190,000 line of credit so that she could pay for private pay care, and she was able to stay for the rest of her days. The choices on how to pay for her care were either her assets, which were already exhausted. The children could write a check, we could do a reverse mortgage, or she could go on to Medicaid. She didn't want to go to Medicaid, she didn't want to move to a facility, so the reverse mortgage became the method of choice to pay for her care. Another lady that came to us at age 101 had a Social Security income of $403 a month. Mortgage payment was $1,634 PITI. In her case, she bought the house 15 years earlier, which means she bought it at age 86 with 20% down and had significant equity in the house by the time she was 101. But things were getting difficult for her at that point, as you could see. The reverse mortgage eliminated the mortgage payment, actually in her case, with the life expectancy set aside, we eliminated the entire principal, interest, tax, and insurance payment. We got her an additional $800 a month for the rest of her life, which made a $2,400 a month difference in her cash flow. And that's a huge change in lifestyle for somebody at that age, to move them from $400 a month up to and improve their life by about $2,400 a month. This one closed this year. It was a lady that I had been talking to for 6 years about getting a reverse mortgage. She started out wanting to move to a different home. That never happened. And it was a challenge for her to move because of the stuff in her existing home. What triggered things to move forward was that she lost her job at age 82 and didn't look like she was going back to work again. So she had $19.16 a month in Social Security income. She had a $655 P&I mortgage payment. So we eliminated the mortgage payment. We got her a payment to her of $14.51 a month for as long as she stays in the house. And we also got her $60,000 for debt consolidation and repairs. Put a new roof on the house, fix the gutters, and do some other deferred maintenance. By eliminating the credit card debt, that improved her cash flow about $16.69 a month. So her total cash flow change was over $3,700 a month, plus the money to do the repairs on the house. Huge change for her to stay in her house. Yet when I look at the situation, the taxes, insurance, and maintenance to stay in a 4-bedroom house in Arvada was $557 a month. If she sold the house, spent down, tried to go on to subsidized housing, 30% of her income was $574 a month, or almost $575 a month. So kind of your choice whether you want to stay in a house or whether you want to try to get on the line for subsidized housing. From my perspective, a reverse mortgage in an existing home is very competitive with subsidized housing if someone will take a look at it before they sell the house. After they've sold the house, typically the money is dissipated pretty fast and it's very difficult to get back in. This couple came to us with a $440,000 house in Arvada. No, that's the next slide. This man at age 64 was already on Medicaid. He had a $322,000 house that was free and clear. He had a Social Security income of $849 a month, and he was able to get $890 a month in additional income. So the new total was $1,739 a month, which kept him under the income limit for many of the Medicaid programs. I'm not a Medicaid expert, so we had him check with a Medicaid expert. They said this would all work with Medicaid, and so it put him in a situation where he was able to live better in his home and stay on Medicaid. But I'm an advocate of checking with Medicaid experts about this to make sure you don't disqualify yourself on Medicaid when you do something like this. This is the one I was almost jumping a slide. This couple came to us with a $440,000 home, and we talked about selling it and moving to a condo. When I took out money for closing costs and paying off the existing mortgage, they could buy a $180,000 condo for cash and have no mortgage payment. We estimated that the taxes, insurance, HOA, and maintenance on the condo would be about $700 a month. When I showed this to a real estate agent, she said $300 a month in HOA fees light. It'd be higher than that today. Taking a reverse mortgage on the existing home, taxes and insurance were $482 a month. $355 more for utilities and maintenance, $737 a month. Essentially, they were in a situation they could stay in the $440,000 home with a reverse mortgage for about the same monthly cash flow as moving to the $180,000 condo. Again, it's a choice. Where do you want to live? And when the monthly charges are about the same, many people would prefer to stay in the bigger home in the old place. And the question routinely comes up is, what about maintenance for things on the old house? Market number one son can solve those problems for people, typically for a lot less than what the HOA fees are going to be on a condo, is the issue. This was a lady in Longmont. She and her husband were doing just fine on 2 Social Security checks with a mortgage payment. It all worked fine until husband died. When husband died, one of the Social Security checks went away. Social Security dropped to $17.90 a month, and her $886 mortgage payment wasn't going to leave her enough to live on. We did a reverse. Her brother-in-law sent her to us. We did a reverse mortgage, eliminated the principal and interest portion of the payment. Again, reverse mortgage taxes and insurance and maintenance were estimated at $364 a month. If she went to subsidized housing with $790 a month in income, 30% of that would be at $537 a month. So given a choice between staying in her long-term home versus selling the home, spending down, trying to get into subsidized housing, she could stay in her house for less than the cost of subsidized housing. And in many of these cases, when I'm comparing the subsidized housing to staying in the home, it overlooks the fact that the homeowner often has extra bedrooms that could be rented out to generate more income. Or like one lady, I may be getting ahead of myself, but we've got one client who we did a reverse mortgage. She rents out an upstairs bedroom. She rents out a downstairs, a basement apartment. She's trained her tenants to do her cooking for her and her outside yard work. They're paying her to keep her in her house without a mortgage payment. Now, once somebody gets a reverse mortgage, if they have one, they can they have the opportunity to refinance it if the situation gets better for them. The first example here, a couple came to us with about $25,000 left on their line of credit. Again, about several years ago, the home value was $230. New reverse mortgage provided $5,000 cash at closing, $43,000 in a line of credit. So we essentially doubled what they had available to spend. We paid all the closing costs on that loan, and they got more money out of the line. Yesterday, I met with one of my past borrowers. We've done 3 reverse mortgages for him. I'm working on the 4th one. We did a reverse mortgage when he bought his property in Brighton. We've refinanced it twice. The property has gone up enough that it's worth refinancing again. This couple came to us with $15,000 left on the line of credit. Property had gone up in Broomfield significantly faster than the reverse mortgage. When we refinanced it, we gave them a $114,000 line of credit. So basically, they picked up $100,000. They did pay some closing costs on that transaction, but paying some closing costs, to gain $100,000 in a line of credit makes it pretty easy to justify when you look at the total numbers. And all I need, if someone wants to evaluate a refinance, all I need is a copy of the mortgage statement and birth dates, and I can do the evaluation for you for free. I know that if you have a reverse mortgage, you get solicitations for refinance several times a month because I get them. I have a reverse mortgage, but those are from people who are just pulling the numbers from the public record data, or they'll buy it from the credit reporting agencies, and so you get solicitations for refinance. Typically, they don't have the real numbers for you, and I can give you the real numbers for free pretty easily if I get the existing statement, and birth dates is all I need. The rest I can look up. Some people plan ahead for a reverse mortgage. In this case, a friend of mine, we had done several loans as he moved around, but he'd had a stroke and wanted to move back into the neighborhood he used to live in. His income at the time we did this transaction was about half Social Security income and half from a disability income policy that was tied to his work. The disability policy ended at age 65, and so he was subject to an income drop at age 65. We sat down and talked about what he wanted to do. He could afford to buy the house he wanted with a traditional mortgage, make the payments on that to age 65 with the employment disability income, but he could not afford the payments after 65. So the plan was to home with a traditional mortgage, refinance it into a reverse mortgage somewhere between age 62 and 65, and that would eliminate the mortgage payment so he could stay in the house for the rest of his life. Those are the kinds of things that if we sit down and talk about what you want to accomplish, and I don't think of these loans in terms of you got to have one. I think of one as a solution to somebody's plan or financial plan for whatever they want to accomplish. This lady came to us as a real estate agent. She had an investment property that she inherited with a loan on it. Her primary residence was free and clear. We did a reverse mortgage on her primary residence, used the money from that to pay off the loan on the rental house that was next door. It provided her with rental income and a home to live in with no mortgage payment on either one. She did have to pay taxes, insurance, and maintenance on both homes, but put her in a pretty good financial position as she was doing that. This lady came to us, was a healthcare professional. She was retiring. She had no need for immediate money. She was in good shape as far as pension and Social Security income, but she, as a healthcare professional, understood how fast health issues can change. So we set up a reverse mortgage line of credit on her home that was free and clear. It gave her $100,000 available as a line of credit that grows with time at the interest plus mortgage insurance rate. And it put her in a situation where if she needed money, she could just go to the reverse mortgage servicer and ask for money, and it would be right there readily available. Much better situation than the one I had leaving a senior show up in Longmont. It was on a Tuesday. The call came in and said, we've got a client leaving the hospital on Friday. They need $16,000 for a rehab facility. What can you do? And the answer was nothing. I can't do anything in that kind of time. If it was a reverse mortgage like mine, I get the paperwork to pull money out of my line of credit each month with a monthly mortgage statement. I can fill out the paperwork, scan it, email it in, fax it in, or mail it in. When they receive the paperwork, they'll process it. It'll show up in my checking account a few days later. Some people want to use a reverse mortgage so they can quit their job, and they'll use it to backfill the income. Some people, we had some people become motivated when COVID hit. They lost their job, wanted to get it in place because of job uncertainty. And my suggestion is get it before you need it, because we just I just sent out the paperwork for one lady that waited too long. Her income dropped off and she doesn't have the income to qualify for the reverse mortgage. In January, February, she had the income to qualify, and when she lost the job due to COVID and has not gone back to work making that money, she's stuck and can't get one right now. Can be used to supplement Social Security income, which would have been her situation. We've had grandparents come to us to want to refinance and lower their payments while we're raising grandchildren. My suggestion is keep the job until the mortgage is funded and don't wait too long, because income can drop off, debts start to build up, and these loans are underwritten on income, assets, and credit, just like the other products that we have. Some common myths. The lender owns the home is the big one we hear all the time. The lender does not own the home. The lender does not want the home. What they want is when the loan comes due, either when the borrowers leave the home, if it's two, when the second one leaves, then they want the heirs or whoever to sell the house, pay off the loan, get their money back, and walk away smiling with some money from the home. Home does not have to be free and clear. We've talked about that. It's useful to get rid of mortgage payments. Some people think you're limited on what you can do with them, or you have to pay taxes on them. There's no restriction and no taxes on it. And a common thought is that only poor people need reverse mortgages. I've got reverse mortgages for people with over $1 million in other assets. They use them as a investment planning tool. It's a great tool during times like this year when the stock market took a huge drop. Instead of liquidating assets at the bottom and when the stock market dropped, if somebody has a reverse mortgage line of credit, they pull money out of the reverse mortgage. When the stock market recovers, then take the money out, liquidate it in an orderly way to pay back that loan. And it can be an excellent money management tool for volatility situations like we saw this year. This slide has to do with people thinking that they're too old to buy a home. This man bought a condo in 2013. He bought it with nothing down, and it was a two-bedroom condo here in Arvada. I'm in Broomfield. His total payment was $883 a month when he came to us. He did a reverse mortgage about 5 years later. He eliminated the mortgage payment. His taxes and insurance and HOA fees were $345 a month when we did the loan. I think you'll have a hard time finding a less expensive place to live than $345 a month. And that one is a two-bedroom condo, so he still has a spare bedroom that he can rent out for somewhere between $500 and $1,000 a month. I don't know what it would bring. As you get into this time of life, denial is not the answer. The questions you need to answer at this point are things like who's going to make medical decisions or financial decisions, who's going to decide whether to keep, sell, or allow foreclosure on the house, who's going to handle the estate. We have resources available. We know people in all of these areas that can help you walk through this process. Amanda Varga with CareTrex is a great resource in this area, and she can help you thread through this time of life. Another piece that's important is who knows where the safe deposit box, the keys, the combinations. The mortgage statement is important on a reverse mortgage because the county records won't tell you anything useful. You need the mortgage statement. Where are bank accounts, where are usernames and passwords. I've got one man we're talking to owns several properties in Colorado, but he also owns one in Oregon. Do your heirs know where those properties are to get the records on them? These are some websites that can be useful for resources. And as we're getting to the end. We're right at 30 minutes at this point, so it looks like there are some questions, and maybe Lindsay wants to send those to me.
Great, thank you so much. We had a very vibrant Q&A that kind of came up through your presentation, so we're really excited to dive into those.
Good.
So I did have one. I know you mentioned that, you aren't a Medicaid expert, but you do refer to experts. But I did want to make sure that this person's question was answered as best as you can. So if someone does have a reverse mortgage, can they still qualify for Medicaid? Is that a yes or no answer? Is it kind of case by case? What do you think about that?
Well, it's ultimately case by case, because the issue with Medicaid is that you have both income and asset limitations. And the important thing for somebody that's on Medicaid with a reverse mortgage is to be careful, be sure you understand the tripwires. The common ones are that you can have a reverse mortgage and it can put you over the income limit, but I also have experts who know how to handle that situation. And if you're $50 a month over on income, it may be worth putting that into a trust and picking up the Medicaid benefits. If you have a reverse mortgage line of credit, you take money out, put it in your bank account, you end up having too much money in the bank account at the end of the month, it can find you disqualified. So I've known of situations where the reverse mortgage borrower did not handle the finances correctly and successfully disqualified themselves from Medicaid. Handled correctly, the two can play together. It's why I bring it up, because it's important, one, to understand the rules, and and from what I understand, those rules can be interpreted differently from county to county. So I don't want to wade into the weeds on those. I just know it's an important issue for people in this age group, and I'd rather send them to the experts than me try to answer the questions.
Right. No, that makes great sense. Do you know if anything does happen to the home value if they choose to move forward with a reverse mortgage and Medicaid?
What do you mean to the home value?
It's mentioned to be used for assisted living or nursing home assistance.
Okay, you have a couple of issues here. One is that you're probably the top complaint to Consumer Financial Protection Board is that people get a reverse mortgage, and the purpose of the reverse mortgage is to turn the equity into the house into cash so that they can spend it. But ultimately, they can only spend the money once. You can't spend it twice. So if you get a reverse mortgage and spend the money out with it, there's going to be less equity than if you didn't.
Mm-hmm.
The reverse mortgages, as they're structured today, I can't speak to all times in the past since 1961 when the first one was done. But the way they're structured today, they're intended to have equity left over at the end of the transaction. And we provide an amortization schedule at closing and at application time that gives you an expected appreciation on the home and expected growth on the growth rate on the reverse mortgage, and you can see how much equity is expected to be in the house. The reason we want to see equity at the end is because if there's equity at the end, then either of two things are going to happen. Either the borrower is moving to an assisted living of some kind, they need the money to make the transition, or if they've passed away, then we want the heirs to sell the house, pay off the loan, and walk away with some money. We do not want the house to go into foreclosure at the end. The last number I heard was that FHA was recovering 35 cents on the dollar out of foreclosures. which means they lose a lot of money and they don't want to do that. And a foreclosure is the only way the bank gets the house. So it's not something they want to do.
Right.
It's like any other mortgage. The bank just wants the money back with interest. They don't want the house.
Right.
That's,
So we did have a couple questions come up in regards to the deed. So I'll kind of put those both into into one question. But so how does the deed title change exactly?
it doesn't.
It doesn't. Great.
You, Lindsay, I'm guessing you own a home. Is that true?
No, I actually don't. I'm a renter. So
You're a renter.
yeah.
Okay. Let's assume that you're a homeowner. You have a mortgage on the house. The deed's in your name. There's a lien against it to secure the mortgage, and that's it. You can sell the house anytime you want. If you sell it, the proceeds of sale go to pay off the mortgage first, and then the homeowner walks away with whatever's left. And this is just another mortgage. The only real difference between this and a traditional mortgage is that instead of making monthly mortgage payments each month, the mortgage payments are optional. You can make mortgage payments on a reverse mortgage if you want to. They're not required. And if you don't make the mortgage payments, then we just add the interest and the mortgage insurance to the loan balance each month. So you have a growing loan balance, but you still own the house.
So kind of a little bit of a follow-up to that question too. Does a deed title in the name of a trust qualify in this case?
Yes. The home can be in a trust, and if it's in a trust and we do a reverse mortgage, the most common way to do it is take it out of the trust, close the loan in the borrower's name, and then put it back in the trust. It can also be done in the trust. We need the trust documents. We need to see who has the authority to sign the documents. And it's important not to do something like one of my clients did. I had to find an attorney who could fix it, but she put the property into a trust and then shredded the trust documents, which created a problem because we needed the trust documents to close the reverse mortgage. I found an attorney who reconstructed the documents and sold it to the title company. And so when putting it into a trust, it's important to understand what you're doing and how to handle the trust, because again, that's an area that's outside my expertise in terms of setting up trusts or handling them, but it's important to do it correctly.
Awesome. And so let's see, our next question from the audience. How does the owner or resident and recipient of a reverse mortgage actually pay the reverse mortgage company back? And then how do the funds get to the homeowner?
Okay, two separate questions. The funds get to the homeowner when we close the loan. If there's a mortgage on a property or other liens, we will pay all of those off, and they will be paid off with a reverse mortgage. Then the payments go to the borrower. The balance increases with time. When the borrower is done with the house, the loan comes due. Done with the house means that they either they've either passed away or they have moved out for whatever reason, and it's time at that point typically to sell the house. If it's a case where the borrowers have died and the heirs want to keep the house, that's not a problem. All they have to do is pay off the loan, and they can pay it off either by refinancing it into a traditional forward mortgage, or they can pay it off with other assets. I have one client who inherited a house in California and was going to use that money to pay off the reverse mortgage on the house in Arvada. So it can come from either a refinance or it can come from other assets. But all the bank wants is their money back when you're done with the house. All it's required to keep it in the loan in place is you have to pay the taxes, pay the insurance, maintain the property, and live in it as your primary residence. As long as you do those four things, it won't come due until the borrower turns 150 years old.
Okay.
And nobody's made it that far. You might, but I'm probably not going to make it that far.
Oh, come on.
Last time I looked, the oldest person in the country was 113, and the oldest in the world was 117. So I think we've got a little cushion there for at least for a couple of days.
Right. Until something else comes around.
Yeah, whatever.
Okay, great. So next question from our audience. If my condo HOA does not currently qualify for FHA loans, will I be prevented from getting a reverse mortgage?
Maybe and maybe not. The proprietary products will sometimes work for those. If it's a condo, it has to be approved by the lender, whether it's a proprietary product or an FHA product. I'm working on one right now where the condo was approved up until June. They were working with another lender. The HOA let the condo approval expire, and this gentleman wants a reverse mortgage. The condo is approved for a proprietary product, so we're moving forward with that product instead of an FHA reverse mortgage. I also have access to consultants that will help the HOA get approved if the HOA wants to do that. The important piece is that the HOA has to want to do it. We will pay the cost for the consultant to help them do it. We will not pay the cost for the HOA to buy insurance or whatever else they have to do to qualify for FHA. And if it's not approved and you want to get it approved, I'm happy to talk to somebody about how to get their association approved. But ultimately, it's the choice of the HOA board whether they want to move forward with it, FHA approval.
Great. And so then kind of staying on the topic of FHA, we did have a question in regards to the 2% FHA mortgage insurance that you mentioned a little bit earlier. So is this kind of a one-time deal, or is it yearly, monthly?
It's 2% of the property value upfront at the time of closing, and then there's a 0.5% per year on the unpaid balance that is an ongoing mortgage insurance charge. On a refinance of one of these, there is a credit for mortgage insurance paid, which is why I need the mortgage statement so that I can find out how much of a credit we get based on the old loan going into the new loan. It's that credit on the FHA mortgage insurance that can make it possible to do a refinance with no cost to the borrower. And by no cost, I'm meaning we're not adding anything to the loan balance to pay for the refinance. So on a refinance, it's important to get the details, and that's why I just say that's what I need, and then I can give people real numbers on it. But it's that 2% up front. It can be on some houses, particularly if you get up into Boulder, that can easily be a $15,000 charge or higher.
Mm-hmm.
And when people see it, they sometimes get excited about it. The issue is that's often overlooked is that the products that don't have the mortgage insurance charge charge a higher interest rate. And so it's kind of like the Fram man said years ago, you either pay me now or pay me later, but you're going to pay for it.
Eventually.
Yeah, one way or another, the bank gets paid, and it's not coming to me, so I can laugh about it and joke about it. I'm happy to sit down with anybody and explain what the reasons are. What the FHA mortgage insurance pays for, people often overlook the importance of it, is that the mortgage insurance guarantees that the borrower will never owe more than the house is worth, number one. So if the property does not appreciate as expected, the borrower will never owe a short. It's a non-recourse loan. It also guarantees that if you set up what's called tenure payments, TENURE, those payments will last as long as you stay in the house, even if you outlive the equity in the house, even if if FHA misses on the projections, you still get the money. And the money in a line of credit is guaranteed by the federal government to be there for the life of the loan. Unlike a home equity line of credit, where the bank can shut those off basically anytime. I had mine shut off in 2008. They said it was because property values were declining. It wasn't. It was really because the bank was in trouble and they're running out of money. And we saw some of the same thing happening earlier this year when the COVID hit. Chase, for one, quit doing home equity lines of credit. I don't know whether they pulled any back or not, but we were right on the edge of having them pulled away again this year with the stress on the financial system. So the trade-off between a reverse mortgage line of credit and a home equity line of credit, the home equity line of credit can be shut off anytime. The reverse mortgage line of credit cannot. The reverse mortgage line of credit is there for as long as you're in the house or to age 150. A home equity line of credit is typically open for 10 years, and at the end of 10 years it comes due, and the borrower is going to have to qualify for something else to pay that off. And I've had people in a situation where they took out too much money by refinancing with a home equity line of credit, and they couldn't get a reverse mortgage. They needed some. One I think of offhand needed about $30,000 cash, and he didn't have it because he had refinanced too much out of the house.
Wow.
So there are ways to get stuck on this thing by using the house as a piggy bank and spending too much out of it.
Right.
And I'm happy to talk to anybody about those situations in detail.
Okay, so we already mentioned that no one has yet lived to 150.
Right.
We did have a question come up during that little portion. So if a recipient of a reverse mortgage dies without any heirs, who pays off the reverse mortgage provider?
Who gets the house? There's equity. Here's the thing. If you have no heirs, it would be in your interest to pick somebody to get the house. If you die with no heirs and no will, then basically what you're doing is giving away the equity in the house. My suggestion would be to pick a church, pick a charitable organization, pick whoever you'd like to fund, and make arrangements with them so that when you die, the house transfers to them. They can sell the house, pay off the loan, and walk away with some money. The other alternative, if there's no equity in the house, then you can just abandon the house into foreclosure. FHA will foreclose it, and that equity in the house is lost to, you basically gave it to the government. The other piece that's often overlooked with Medicaid is that Medicaid has an estate recovery process that they're required by the federal government to do. So they pay whatever they do for someone's health care. You can keep the house while Medicaid's paying the bills, but when they pass away, the Medicaid can have an estate recovery claim. The reverse mortgage holder gets first claim to the house, but then Medicaid may have claim to the rest of the equity in the house. The reverse mortgage may well be spending Medicaid's money in the process. And if somebody wants I've got the booklet on my bookshelf behind me there with the Medicaid estate recovery process. I can email it or mail it to anybody who wants that information. I've got a lot of information that I can send to anybody that wants it. I just have to contact me.
Great. So can I get a reverse mortgage on unimproved land?
No. Tent does not qualify as an FHA approved structure. You're going to have a house on it to get a reverse mortgage, but you can buy a house with a reverse mortgage, but not. It has to be a primary residence.
Okay. So kind of on the opposite side of that, can you buy a second home, for example, using a reverse mortgage?
Yes, if that's a qualified yes. You cannot put a reverse mortgage on the second home, but you can do a reverse mortgage and use the funds. Let's say you have a house that's free and clear. Let's say you have an $800,000 house, for example, and you can qualify for a $400,000 reverse mortgage. You could do a reverse mortgage on your primary residence, take that $400,000 and use it to go buy a second home. The loan will be against the primary residence, but you can use that money to buy something else. I had a case about a year ago. There was a property. I got a call from a real estate agent, wanted to know if I could save it from foreclosure, and the borrowers had waited too long. I said, tell you what, if you get a listing on it, I'll give you a cash offer on it. And I was going to buy that property. My offer would have been funded completely with money out of my reverse mortgage. I just needed a few days to get it out.
Right.
Could have paid cash for it. And my wife said, what are you going to do with it if you buy it? And I said, well, if I get it for what I'm offering, I'll worry about that after I get it, because I can sell it or rent it or
right.
whatever. Yeah, I didn't end up with it because somebody else was willing to pay more. So,
and that's one of those we're talking about too, right? That there isn't really, a limit on how you can use the funds that you receive, right?
No, you can use it for whatever you want to use it for. FHA limits how much you can get in the first year, but it was the advantage to having ours in place for more than a year. So all the limits on what I could pull out were off, and I could take the entire balance out and go buy that property, and I had enough available that I didn't have to liquidate any other assets. I just pay for it with money from the reverse mortgage, and then if I wanted to keep it, I could refinance it into a different loan, or I could sell it, or whatever I wanted to do with it. But it gave me the immediate money to pay cash for a property.
So what happens if someone takes out a reverse mortgage and then they don't necessarily want the full amount that they qualify for? What do you have any recommendations or anybody kind of examples of what people have done?
Yeah, leave it as a line of credit. In my case, I'm sitting here with when we closed on our reverse mortgage, we rolled the closing cost onto the reverse mortgage. Then we paid the closing cost down. I've got about an $800 balance on the loan. I don't want to pay it to zero because I don't want them to close it. So if I have a few $100 balance on it, they can't close the loan on me. And I've got access to the rest of it until Terry turns 150. She's 10 years younger than I am, so she's got more time on it than I do, is where we are. I keep joking about this stuff because I'm to the age where I can joke about it and hopefully not offend too many people that are watching.
Well, great. Thank you so much. It looks like that's all of the questions that, both I had and the audience. Thank you everyone for tuning in with us today. It's very rarely that you get to hear from, people that do this for a living, the experts. And so for us to not only have some expert advice from Donald, but to also get something from somebody who is the president of a company that is really valuable. So thank you, Donald, for your time today.
You're welcome.
Yeah, so like I said before, this is being recorded and you can access it again on our website, timescall.com/aging. And so Donald did have some resources and some points of contact that you can use or refer to, and that's where you can go ahead and find that again, because I know we kind of went into the Q&A portion after those slides were shown. So again, thank you so much. We will be back on Monday for our next webinar, so we hope to see you then. Have a great weekend.